This is the World Financial Report on Radio with Harold Siegel. My name is Randy Marshall. Joining us via the telephone, our financial expert, Harold Siegel. We're taping the show on September 23rd, 2011. Our time is 8:37. That's Mountain. 10:37 Eastern. The radio show runs on AM 640 in Toronto, 630 CHED in Edmonton. If you ever miss a radio show, you can hear all the shows archived on Harold's website, hesradio.com, hesradio.com. As we talked about a few weeks back, Harold started doing the show shortly after 9/11. I joined him in February of 2002. We've been doing the show a long time. And I know for people who have just been listening here in the last few years, you don't quite remember all the ups and downs of the markets. But Harold and I do. From the very early days of this bull market, there have been a lot of up days, and we've had a roaring bull market, and we've seen our pullbacks too. But the good thing is, Harold, it's our experience of doing it for so long. We know that this is a solid bull market. The fundamentals have not changed one iota. In fact, if anything, they've gotten better when you see what's happening around the world with the sovereign debt crisis, all the problems in the United States. Nothing is being fixed. And sure, we may have a short-term pullback, but the truth is, the trend is your friend. As you've said in the past, the fundamentals have not changed. If anything, they've gotten better. And I think the best days of this bull market in hard assets, precious metals, is still to come.
I agree with you, Randy. I certainly do. This was a tough week. There's no doubt about it. The markets came down very heavily. As we said on every show, especially since, silver got up to $50 and gold got up to $1,900, that extreme volatility was going to be the rule. We are going to see, severe volatility in these markets, and that will continue. If gold's going to get to $4,000 to $5,000 or higher, and silver's going to get to $150 to $200 or higher, there's got to be volatility in the market. And basically, there is a huge difference between trading the paper markets and trading the physical market. Basically, physical gold and physical silver is where most of the money is at this point here. In actual fact, the vaults are full with physical gold and silver, and every time any country sells gold, it's China and India that jumps in and buys it. So basically, what you see in these markets, when the markets do pull back like they do, it's the technical markets. Now, you've got the futures markets where mostly gold and silver is traded. It's very heavily leveraged. It can be leveraged 30, 40, 50 to 1. So basically, this is a shorter-term, trading mechanism that traders use, to trade and hedge the gold and silver market. And we've seen gigantic moves in the markets up and down in the last 10 years that we've been in this market. In actual fact, this is, I believe, the 9th time that we've seen this type of substantial pullback in the market, where silver, for example, has dropped from $40 down to $33, a $7 drop in the market in 1 day. In 1 week. That does not change the fundamentals of the market. Again, when we first started buying silver, silver was at $4. When we first started buying gold, gold was at $2.50. The reason that gold and silver were at those lower levels at that time was because the U.S. economy and basically the world economy was strong at that point. If you remember back in the 90s, you had, a very strong stock market. You had a very strong U.S. dollar. It was the strongest currency. You had no employment problems and no problems really back at that time. However, that has totally changed. And the major reason that we recommended gold and silver back 10 years ago, and this is the same reason that we're recommending it right now, is because of inflation. So as confusing as everything is out there with the currency markets, with the oil markets, with the commodity markets, with the stock markets plummeting all over the world the other day, these are all situations that are feeding off of short-term information. But the bottom line is that there's so many problems out there that it's absolutely confusing at times. What are these situations going to actually do to the market? Are we going to have inflation? Or are we going to have deflation? What's going to happen to the stock markets? What's going to happen to the bond markets? And what's going to happen to the currency markets? Well, one of the major situations this week, and one of the reasons that gold and silver did drop, was primarily because of the currency markets. Now, we've been saying for a long time that the currency markets, there's going to be currency wars. There's going to be changes in the currency markets that are going to defy description, and they are going to affect affect the markets in a major way. What we are seeing at this particular time, which is absolutely shocking, is what's happened to the Swiss franc. The Swiss franc at one time was the currency. It was the safest currency in the world. Let's face it, we always thought of Switzerland as the place that is safe. It's got, special, relationships with banks, and it's always been the safest place to put your money. And the Swiss franc was always the safest currency. Well, the Swiss franc isn't there anymore. In actual fact, the Swiss are going to have to go on the euro, and we know that the euro is probably going to be gone within 2 years. So this is all the situations that I'm referring to, is that we're getting major changes in the currency markets. Why would the U.S. dollar actually rally? Because the Swiss franc was in trouble? Basically, it's a short-term flight to quality. But let's face it, who in the world could be bullish on the U.S. dollar? That's a ridiculous thing to even think. So for short term, you see a rally from 74 cents to 78 cents in the U.S. dollar. We saw a 4-cent move in the market over the last week and a half, and basically it's sitting at about 78.30. I would have to see the U.S. dollar break above the 80 to 81 cent level in order for me to think that we are going to see a further rally in the dollar. But the fact is that there's no chance that the dollar, the U.S. dollar, is going to continue to rally, because the U.S. dollar is actually in worse trouble than the currencies in Europe. And basically, what we are going to see, and we know that we have to see the U.S. dollar fall further, is because the Federal Reserve is going to keep the interest rates in the U.S. as close to zero for the next 2 years. And we also know that the U.S. government cannot pay the debts that they owe, the interest on that $15 trillion. So basically, they have to print the money in which to do so. Greenspan has come out and said, not Greenspan, but the Federal Reserve has come out and said that they can print all the money they want, and they're not going to default on the debt. But we know that by printing all that money, it's got to reduce the value of the dollar. So what happened in the market this week, again, there was a gap technically in the market that had to be filled on the downside, and that's what they did. And it was a fairly big gap that brought the market from $40 down to about $32. Now, there's very heavy support in silver at $32. We did hit $31.85, but again, if we close above the $32 level today on Friday, then again, I think it's building a very strong base, and will build a strong base around the $32 level. So I think at this point, we're fairly safe to buy silver at this level. The gold market, there's very heavy support at $16.50, and we hit $16.80 on Friday as we're taping the show. So again, I would say at these levels, you're never going to pick the exact top or bottom of the market, but basically if you are going to buy back into the market, I would say we're fairly safe in and around these levels. Again, technically, there was a gap in the market that had to be filled on the downside, and they did that. Now I think that that's pretty well out of the way, and we should start to see this market build a base again at 32 and start to rally up from there. As quickly as this market comes down is as fast as this market can go up. These are not the markets of the past. These are markets of the hedge funds. It's basically not the small investor that's in the market, because in the futures market, they're getting killed. They can't afford to stay in that market. They raised margin requirements at the COMEX 5 times in 1 month in May, if you remember, and that also caused the price of silver to fall down. Silver fell to $34 at that point, came all the way back up to $44. It fell back down to $33 today, and now I think that this market's going to start to work its way back up. With all the confusion out there, and let me try to simplify this for you, the sovereign debt situation, the situations in all throughout Europe, the situations in the Middle East, which are getting extreme, the very bad financial situations in the United States, all the other situations with derivatives and bonds and countries going bankrupt, and all these scenarios just add fuel to the fire. The one thing that we need to be concerned about, and the one thing that we need to focus on, which is the reason why we're buying hard assets, gold, silver, and diamonds, is because of inflation. And there's no doubt, and I repeat, no doubt in my mind, and many people that are much, much smarter than I am, that we are going to not only have inflation, but we're going to have inflation to the level that we have never, ever seen before. The fact is that in the United States and around the world, economies are falling. There's no way in the world that any economies are growing at this point here, and that's the scenario for the next 5 to 10 years. So basically, we're going to see food prices continue to go higher, we're going to see oil prices continue to go higher, and we're going to continue to see wages drop, and that's a recipe for heavy inflation. on top of the fact that the U.S. dollar, because of the fact that they're not going to raise interest rates and they're going to have to continue to print money in order to pay their debts, there's no doubt that the U.S. dollar is not only going to come back down and test that 71.50 level that I've always told you about, but once it does break that level, we could literally see the U.S. dollar fall out of bed, just like we saw with the Swiss franc, just like we saw with all other currencies. So again, these short-term situations, as maddening as they are and concerning as they are, if you keep your head about you and you do not get emotional about these markets, because when you trade with emotion, you'll make mistakes. When you trade with logic, you're going to have a much better opportunity to stay within yourself, not to get as stressed out, and to make intelligent decisions. And there's absolutely no way, just because the market dropped in this week, that anything has changed in the marketplace except they've chased out the short-term futures traders in the market. And when the market gets low enough, as it is right now, you're going to see the hedge funds jump right back into the market and buy this market up because, again, this market in gold and silver is in a massive bull market. There's no way in the world that gold goes from $250 to $1,900 and all of a sudden the trade is over. Nothing has changed in the economy, and in fact what Randy said this morning at the opening is 100% true. Not only has nothing changed fundamentally, the only thing that has changed is it's got better for precious metals. So again, I understand when these markets pull back that people get nervous. If you're heavily leveraged, you have reason to be nervous. If you're in physical gold and silver like we recommend, again, it's just another blurb and another buying opportunity, and this is the 9th time in this massive bull market that we've seen a pullback similar to this. Again, I would be a buyer of silver, especially in and around these levels. Again, could it drop to 30? Yes, it definitely could. But again, it could just as easily on Monday go back up to 35 or 36. So again, in and around these levels, I think we're very safe to buy silver. I think we're very safe to buy gold. I know that China is buying as much gold as they can get their hands on, not only the country, but their citizens. Same thing is happening in India, and those are the two economies that happen to be heading in the right direction. All other economies seem to be regressing at this particular point. So again, I understand the stress of when these markets pull back, but again, if you're sitting in physical gold and silver, it really doesn't matter, because before this whole thing is over, we're going to be looking at substantially higher prices in gold, substantially higher prices in silver, and all this really works out to be is just another fantastic buying opportunity.
If you have a long-term vision for this market, as we do, we think the best is yet to come. Speak with the company that Harold recommends you deal with when it comes to investing in precious metals, starting your own precious metals investment account. That is Worldwide Precious Metals. Their website, wwpmc.com, wwpmc.com, a Canadian company in business for the entire bull run of this precious metals market. And we can tell you that they'll be more than happy to help you start your own precious metals investment account today. 1-866-623-2002 is the telephone number to connect with them. Their website, wwpmc.com, wwpmc.com. The telephone number, 1-866-623-2002. If you'd like to receive our free weekly newsletter, and it is packed full of information this week, Worldwide will be more than happy to mail it out to you free of charge every week. 1-866-623-2002, the website wwpmc.com. What started all of this during the week? The Fed came out and they had their meeting and they decided to shift their Treasury holdings to long-term securities in a stimulus step. The Federal Reserve policymakers will replace some bonds in their portfolio with longer-term treasuries in an effort to reduce borrowing costs and keep the economy from relapsing into a recession. So they're keeping the short-term money, or basically they're going to be actually selling the short-term and buying the long-term. And that was done by Ben Bernanke and crew earlier in the week. The market did not like it, to say the least, and that's when we started to see the stock markets plunge. The IMF came out this week and warned of a dangerous phase of economic decline. The world economy has entered a dangerous new phase of declining growth that will require policymakers to take action, according to their chief economist, Olivier Blanchard. This weekend, the G20 meeting, and they have promised that they are going to do whatever they can to try and stabilize the markets and get